Bitcoin is sitting at $63,700 right now, a few hours away from the single biggest catalyst of the month, the Federal Reserve's rate decision, landing at 2 o'clock Eastern this afternoon, with Chair Kevin Warsh's press conference 30 minutes after that. Markets are pricing something close to a 1 in 3 chance of a hike, which is an unusually high level of uncertainty for a meeting this late in a cycle, and Bitcoin has already spent the last several days grinding lower into it. Here's what's actually happening under that price, though, and it's the entire subject of this video. A specific, well-documented mistake is showing up right now, today, across retail Bitcoin holders in real time in the hours before this exact decision. It isn't panic selling. It's quieter than that, and in some ways more costly, because it doesn't feel like a mistake while you're making it. It feels like patience. You've probably already made a version of this decision this week without fully noticing it. Maybe it looked like refreshing a price chart and closing the app instead of acting. Maybe it looked like telling yourself you'll revisit the decision once the Fed statement drops. Neither one of those feels like a mistake in the moment, and that's exactly the point. This video is going to show you exactly what that mistake looks like in holders' own words, what the actual data says while that mistake is being made, and why the gap between the two is worth understanding before 2 o'clock this afternoon, not after it. Let's be precise about the setup, because precision is the entire point of this channel. Bitcoin has been oscillating in a tight band between roughly $62,700 and $65,500 for the better part of a week, with several sharp, short liquidation events along the way, including a $100 million flush inside a single hour just yesterday. The fear and greed index has spent the past week sitting in the high 20s, fear territory. Not the more extreme readings this channel has covered in other videos, but low enough that it's shaping how a lot of holders are talking about today. It's worth being honest about why this specific afternoon carries more weight than an ordinary Wednesday. Markets are currently pricing something close to a 1 in 3 chance of a rate hike, according to CME FedWatch data, an unusually high level of disagreement for a meeting this far into a rate-holding cycle. High uncertainty of that specific kind, where the market genuinely doesn't know which way a binary event breaks, tends to produce more emotional noise per dollar of actual risk than almost any other kind of market setup, because there's no comfortable consensus to lean on in either direction. I'm not going to tell you what the Fed decides this afternoon, and anyone claiming certainty about that is guessing. What I am going to show you is the specific decision a large number of holders are making right now, while genuinely uncertain what happens at 2 o'clock, and why that specific decision has a well-documented track record of being exactly backwards. Before we go any further, I want to mention something, because it connects directly with everything we're about to cover. A lot of Bitcoin holders genuinely believe in the long-term thesis. They understand the scarcity, the adoption curve, why this asset matters over a 5 or 10-year horizon. But on a day like today, with a Fed decision hanging over everything and the fear and greed index sitting in the high 20s, belief alone has never been enough to keep someone from making exactly the mistake this video is about to walk through. That gap between the thesis someone believes on a calm Tuesday and the decision they actually make 2 hours before a Fed statement is where almost all of the damage covered in this video actually happens. It's rarely the multi-year thesis that breaks first. It's the specific afternoon in front of it. That's why I put together the Bitcoin holder mindset. 13 chapters built specifically to help you build the discipline and mental frameworks to make better decisions on exactly this kind of day, not after it. It just launched, so right now it's $27 instead of the regular $47, backed by a full money-back guarantee. If you want a framework for days like today instead of a feeling, the link's in the description. Now let's look at exactly what that mistake looks like in holders' own words. Here's what's actually circulating among retail Bitcoin holders in the hours before today's Fed decision. And it's worth hearing in something close to its own language rather than a summary, because the specific phrasing is the tell. A recurring sentiment making the rounds today amounts to this: most people seem to think Bitcoin is heading lower, so they're sitting on the sidelines waiting to see what happens. A related, more specific version of that same sentiment points to a retest of the high 50,000s as the expected next move, effectively predicting several more $1,000s of downside before it would make sense to act. And running underneath both of those is a fear and greed index that's spent the past several days in the high 20s, low enough that plenty of holders are describing the setup, combined with an 11-day low in price heading into a 2-day FOMC meeting, as reason enough to simply wait. None of that framing is unusual, and none of it is stupid. It's the single most intuitive sounding response to genuine uncertainty. Don't commit capital. Wait for the fog to clear. Act once you actually know what the Fed decided. The problem isn't the impulse. The problem is what waiting for clarity actually costs, and how rarely that cost gets calculated honestly before the decision to wait gets made. There's a specific related version of the same mistake that shows up just as often, and it's worth naming separately because it wears a different mask. It isn't, I'm waiting for lower prices. It's, I already sold or I never bought in the first place because the setup felt too uncertain, which quietly becomes indistinguishable from the first mistake the moment price actually moves without you. One commentator circulating today framed it sharply. Conviction is easy at the highs, and it's the red candles and the uncertain macro backdrop that actually reveal who meant it and who didn't. Nobody finds out they're a long-term investor until they're already down and still holding. It's worth naming exactly why this specific mistake is so easy to miss in yourself, because it doesn't announce itself the way panic selling does. Panic selling has a clear before and after. You held, then you didn't. And the moment is obvious enough to point back to later. Sitting in cash and waiting has no equivalent moment. There's no click, no confirmation screen, no specific instant where the decision gets made. It just accumulates day by day, headline by headline, uncertain afternoon by uncertain afternoon, until months have passed and a position that could have existed simply never did. That absence of a clear decision point is exactly what makes this mistake so much easier to rationalize than an outright sale, and so much harder to ever actually learn from, because there's rarely a single afternoon you can point to and say, that's the one where I got it wrong. None of that framing is unusual, and none of it is stupid. It's the single most intuitive sounding response to genuine uncertainty. Don't commit capital, wait for the fog to clear, act once you actually know what the Fed decided. The problem isn't the impulse. The problem is what waiting for clarity actually costs, and how rarely that cost gets calculated honestly before the decision to wait gets made. None of this means the retail instinct to wait is automatically wrong on this specific occasion. A 31 to 38% probability of a hike is genuinely elevated. And if the Fed does surprise markets with tighter policy this afternoon, Bitcoin, as a pure liquidity-sensitive asset with no earnings buffer to absorb the shock, could reasonably move lower in the near term. Waiting is not inherently irrational. What this video is examining is a specific pattern in why people wait, and what the data says about that pattern historically, not a guarantee about today's specific outcome. Here's the part. Almost nobody making that decision today is actually checked, and it's the entire argument of this video. The data available right now does not support the fear driving that decision, at least not in the way retail sentiment assumes it does. Start with the ETF flow number because it's the cleanest, most checkable figure available. US spot Bitcoin ETFs recorded a net outflow of approximately $49,700,000 on July 28th, according to Farside Investors tracking the fourth consecutive down day. That sounds alarming as a headline until you compare it to the actual size of this market. $49 million is a rounding error against a Bitcoin ETF complex holding well over $100 billion in assets, and the outflow was driven almost entirely by a $54,800,000 redemption from a single fund. BlackRock's IBIT partially offset by a $5,100,000 inflow into Grayscale's Bitcoin mini trust the same day. A single-digit basis point rebalancing inside one large fund is not the signature of an institutional stampede for the exits. It's noise, wearing the costume of a signal. Now look at what long-term holders are actually doing with their coins, as opposed to what short-term traders are doing with leverage. According to on-chain data reported by Coinpedia, Bitcoin exchange reserves have fallen by 78,000 Bitcoin over the trailing 6 months, meaning coins are moving off exchanges into long-term storage. At exactly the same time, retail sentiment online is describing a market supposedly bracing to dump. Coins leaving exchanges is not what preparation to sell looks like. It's closer to the opposite. It's what quiet accumulation looks like, from holders who don't need liquidity on a 2-day timeline built around a single press conference. It's worth being specific about what would actually falsify this picture, because a genuinely useful signal has to be capable of pointing the other way too. If exchange reserves had been rising over the same 6-month stretch, that would be a real, checkable sign of holders preparing to sell into strength or into fear. And this video would be reporting that directly instead of the opposite. The fact that reserves have moved the other way isn't a detail chosen to fit a predetermined conclusion. It's simply what the on-chain record shows, and it happens to run counter to the retail narrative circulating today. And then there's the liquidation data itself, which retail sentiment tends to read as confirmation of collapse when it's actually a story about something narrower. Total liquidations reached approximately $679 million in the 24 hours covered by that data, with $536 million of that coming from long positions and only $143 million from shorts. That imbalance tells you specifically what's breaking. Leveraged, short-term long positions getting flushed out by ordinary volatility, not long-term holders capitulating. A $100 million liquidation event inside a single hour, the kind that made headlines this week, is a story about derivatives markets clearing out excess leverage. It is not On its own, evidence that the people who actually hold Bitcoin for a living are changing their minds about it. Put all three of those data points next to each other. A tiny, single fund-driven ETF outflow, falling exchange reserves, liquidations concentrated almost entirely in leveraged long positions rather than spot selling. None of it matches the story retail sentiment is currently telling itself about today. It's worth being specific about why this particular gap between the loud retail narrative and the quiet on-chain reality tends to open up widest right before events like today's. A Fed decision is a single, sharp deadline, which makes it a magnet for narrative. Every account, every thread, every comment section gets organized around the same countdown clock, and that concentration of attention makes the sentiment feel more unanimous and therefore more informative than it actually is. On-chain data doesn't organize itself around a deadline at all. Exchange reserves fell steadily over 6 months, not dramatically in the last 48 hours, which means it doesn't produce the same urgent, shareable headline a sudden move would. The quiet data is not quiet because it's less real. It's quiet because slow, 6-month trends don't generate the same engagement as a countdown to 2 o'clock. Small ETF outflows and falling exchange reserves describe the last 6 months and the last 24 hours. Neither one is a guarantee about what happens after 2 o'clock this afternoon. A genuinely hawkish surprise from the Fed could produce outflows, exchange inflows, and long-term holder selling that look nothing like the picture described above. And treating today's calm on-chain data as proof that a hawkish surprise can't move the market would be its own kind of overconfidence. Data describing the setup going into an event is not the same as data describing the event's outcome. Let me pause here for a second, because this is exactly where most holders underestimate the problem. Knowing that ETF outflows are small and exchange reserves are falling doesn't automatically change how a portfolio down over the past week actually feels while you're staring at it 2 hours before a Fed decision. Having an actual system that holds up in that specific window is something completely different from just knowing the numbers, and that's precisely what the Bitcoin holder mindset was built for. Most of what makes today difficult isn't a lack of data. You just heard the data in the last section laid out plainly. What makes today difficult is that data and feeling arrive through 2 completely different channels, and only one of them has a documented system built around it. Inside, I walk through the specific psychological traps that cause holders to treat macro uncertainty as a reason to freeze or bail, along with practical exercises you can run before the next Fed decision, the next data print, the next uncertain afternoon like this one. It's still $27 during the launch, $47 after, same full guarantee either way. The link's below if you want to check it out. Now let's get into why wait for clarity feels so reasonable, and why it's historically been one of the more expensive instincts in this entire asset class. Here's the mechanism underneath everything covered so far, and it's the same one this channel has walked through before, applied to a slightly different trigger. Your brain does not experience elevated macro uncertainty ahead of a Fed decision as a probability-weighted scenario to be calmly reasoned through. It experiences it as a threat with no clear edges, which is, if anything, more uncomfortable than a threat you can actually see and measure. A 35% hike probability is not a coin flip your nervous system can sit with peacefully. It reads as something bad might be about to happen, and I don't know how bad, which is precisely the kind of ambiguous, open-ended threat the amygdala is worst equipped to process calmly. Layered on top of that is the same reference point mechanism Daniel Kahneman and Amos Tversky documented in 1979, research that later earned Kahneman the Nobel Memorial Prize in Economic Sciences. Losing a given amount of money is felt psychologically as roughly twice as intense as gaining that same amount feels good, and holders measure that loss against whatever recent high is sitting in memory, not against their actual cost basis. Bitcoin sitting at an 11-day low, even a modest one, gets processed as a fresh loss relative to last week's better price, which makes wait and see feel like caution when it's actually just loss aversion wearing a responsible-sounding disguise. There's a reason this specific disguise is so effective. More effective than the disguises panic selling wears. Panic selling has to overcome a visible taboo. Most holders know, at least intellectually, that selling into a crash is supposed to be the wrong move. So some resistance kicks in even at the moment of doing it. Waiting doesn't have to overcome anything. Every piece of conventional financial wisdom a holder has ever absorbed, don't act rashly, don't chase, be patient, actively reinforces the decision to do nothing, even when doing nothing is itself the rash, emotionally driven choice wearing patience as a costume. That's precisely why this mistake is harder to catch in yourself than an outright sale would be. Here's the part that makes this specific mistake more expensive than ordinary panic selling, and it's worth sitting with directly. Panic selling, at least, produces an action you can measure and eventually learn from. Waiting produces nothing measurable at all. There's no trade to regret, no specific moment to point back to, which means the opportunity cost of sitting in cash through an uncertain afternoon almost never gets tallied up afterward, the way an actual loss does. A holder who sells at a bottom eventually sees the number and feels the specific pain of it. A holder who simply waited and then kept waiting, because the next data point was also uncertain, and the one after that rarely produces a single moment of reckoning at all. The cost is real. It's just invisible, spread out and easy to rationalize one uncertain afternoon at a time. It helps to picture the actual sequence this produces over a longer stretch, because the damage compounds in a way that's easy to miss looking at any single afternoon in isolation. Today, it's a Fed decision. In 6 weeks, it's a CPI print. 2 months after that, it's another FOMC meeting, or a piece of regulatory news, or a geopolitical headline. Each one individually offers the exact same reasonable-sounding case for waiting. Genuine uncertainty, a specific resolution date, a plausible story about why acting now would be premature. A holder who applies that same logic consistently, uncertain event after uncertain event, can go the better part of a year without ever finding a moment that feels safe enough to act, because there is always another uncertain event on the calendar. There is no version of Bitcoin's history, or any liquid market's history, where genuine uncertainty eventually runs out and a moment of pure clarity arrives instead. Understanding the mechanism behind this specific instinct doesn't disable it, and plenty of people who can recite Kahneman and Tversky's findings from memory still find themselves sitting on the sidelines through exactly this kind of afternoon. Awareness is necessary. It has never on its own been sufficient, and nothing about naming a bias guarantees that today, specifically, is a good time to act rather than wait. It's worth being direct about what the historical pattern here actually supports, and what it doesn't, because overstating it would undercut everything this video has covered so far. Fed decisions, rate hike scares, and macro uncertainty have been a recurring backdrop across Bitcoin's entire history, not a new phenomenon specific to today. The specific catalyst changes: a rate decision this year, a banking crisis 2 years ago, a regulatory headline before that. But the underlying retail instinct in front of each one tends to rhyme. Treat the uncertain, unresolved window before the event as a reason to do nothing, and wait for the event itself to remove the uncertainty before acting. The honest historical pattern is that the removal of uncertainty in either direction tends to happen through price quickly, once the actual decision lands, which means waiting for clarity as a strategy usually means paying up after the fact for the exact clarity that was available at a discount before the event, to anyone willing to tolerate the discomfort of not knowing yet. Consider what actually happens mechanically in the minutes after a decision like today's lands, regardless of which way it breaks. If the Fed holds or delivers a dovish surprise, the uncertainty that kept sidelined capital sidelined evaporates instantly, and a meaningful share of that capital tends to re-enter within the same session, often at a price already higher than the one available beforehand, because everyone who was waiting for the same specific green light tends to act on it at roughly the same moment. If the Fed hikes, the capital that stayed on the sidelines avoided a near-term drop, which feels like validation, but the same ambiguous uncertainty instinct is still sitting there unexamined, waiting for the next Fed meeting, the next data print, to repeat the identical pattern. Being right once about a specific hawkish surprise does not fix the underlying habit. It just delays the reckoning to the next uncertain afternoon. This is not a claim that today's Fed decision resolves bullishly, and it would be dishonest to imply otherwise. It's a claim about the structure of the decision retail holders are making, independent of which way today specifically breaks, choosing to wait for an uncertain macro event to resolve, rather than building a position sized and planned in advance to tolerate the uncertainty either way, has a well-documented tendency to cost more than it saves, averaged across enough of these events over time, even though any single instance can go either way. A well-documented tendency averaged across many events says nothing certain about today's specific event. It's entirely possible that today is the exception, the one where sitting in cash through the Fed decision turns out to be the correct call, and no honest reading of this video should leave you believing otherwise. The pattern covered in this section describes a bias in decision-making, not a forecast for 2 o'clock this afternoon. Before we wrap up, I want you to actually sit with one question. After everything covered in this video, what's your actual plan for 2 o'clock this afternoon? Not some vague sense that you'll see how it goes. I mean the specific written version. What does a hawkish surprise change about what you do? What does a hold change? What does a dovish surprise change? And did you decide any of that before you started reading today's headlines? Or are you planning to figure it out live with your gut the moment the statement drops? Because most holders don't lose ground because they stop believing in Bitcoin. They lose ground quietly, one uncertain afternoon at a time, because they never built a plan for exactly this kind of day, and that's the gap. The Bitcoin holder mindset was built to close. This isn't a Fed decision prediction guide, and it's not about calling today's outcome. It's about making sure the next uncertain afternoon, like this one, doesn't cost you the way today might be costing a lot of people watching this video right now. Inside, you'll get the actual mechanism behind why ambiguous macro uncertainty triggers freezing and avoidance, even in holders who genuinely understand the long-term thesis, the reference point trap, explained through Kahneman and Tversky's Nobel-winning research. A dedicated chapter for anyone who has already sold or sat out a moment they regret and needs to rebuild without carrying the shame into the next one. And the complete pre-commitment system, position sizing built around an honest sleep test, a way to decide your response to a hawkish, neutral, or dovish surprise before the headline hits instead of after, and a framework for building the kind of identity that holds steady through exactly this kind of uncertain window. On top of all 13 chapters, you get the full holder's toolkit, the 10 biggest mistakes, the 10 most important mindset shifts, the 10 most actionable frameworks, and a complete master checklist you can actually pull out the next time a Fed decision, a CPI print, or any other uncertain afternoon rolls around. Because the real cost was never $27. The real cost is the version of today that never gets tallied. The quiet decision to wait, again, through an afternoon, the data didn't actually support waiting through, and the version of your portfolio 5 Fed meetings from now that's smaller for it, with no single moment you can point back to and call the mistake. Think about how many of these afternoons are actually still ahead of you. 8 FOMC meetings a year, plus every CPI print, every jobs report, every headline that puts a countdown clock on your decision making. If today's specific pattern, treating ambiguous uncertainty as a reason to freeze, repeats even a handful of those times over the next 12 months, the cumulative gap between the holder who had a plan and the holder who didn't stops being a rounding error and starts being the actual difference in where each of them stands a year from now. That's the gap this book is built to close, not just for today, but for the next uncertain afternoon and the one after that. The regular price of the Bitcoin holder mindset is $47. Right now, during the launch, it's $27, and there's no risk in trying it. If it doesn't leave you with a clearer, calmer way to handle days exactly like this one, you get your money back. No questions asked. The link's in the description and pinned in the comments. For less than the cost of a nice dinner, you can build the mindset that turns the next uncertain afternoon into a plan instead of a guess. Bitcoin is sitting near $63,700 ahead of today's Fed decision, with retail sentiment widely expecting further downside and describing the current fear and greed reading in the high 20s, alongside an 11-day price low, as reason enough to wait rather than act. The actual data available right now tells a different story. A $49,700,000 ETF outflow driven almost entirely by one fund, 78,000 Bitcoin leaving exchanges over 6 months, and liquidations concentrated overwhelmingly in leveraged long positions rather than long-term holder selling. The mechanism behind the mistake isn't a lack of information. It's the same amygdala-driven threat response and roughly 2-to-1 loss aversion bias this channel has covered before, applied here to ambiguous macro uncertainty instead of a straightforward price crash, made worse by the fact that waiting produces no measurable moment of regret the way an outright sale does. A written plan, built before the uncertain afternoon arrives, is what closes that gap, and it's exactly what the Bitcoin holder mindset assembles into one system. The specific shape of today's mistake is worth restating plainly because it's easy to let it blur back into ordinary panic selling once the video is over. Nobody in this video's section 1 was described as selling. The mistake was never selling at all. It was choosing to do nothing, framing that nothing as prudence, and then carrying that same framing forward into the next uncertain event and the one after that, without ever building the plan that would let doing nothing be an actual decision instead of a default. Nothing in this video, or in the book it points to, should be read as a prediction about today's specific Fed decision, and a 31 to 38% hike probability is genuinely elevated enough that caution is not, on its own, an unreasonable posture. Small ETF outflows and falling exchange reserves describe recent history, not a guarantee about how markets react in the hours after 2 o'clock. The pattern this video documents is a tendency in how retail holders make decisions under ambiguous macro uncertainty, not a forecasting tool, and treating it as one would be exactly the kind of overconfidence this channel has warned against before. It's also worth being honest that a hawkish surprise this afternoon could, in principle, validate every retail instinct covered in Section 1, at least for the following few days. If that happens, the temptation will be to treat this video's argument as having been wrong. It wasn't wrong about today specifically. Nothing in this video claimed certainty about today specifically. The argument is about the tendency, measured across many similar afternoons, not a guarantee about this particular one, and a single confirming or disconfirming outcome today doesn't settle that broader question either way. The fatal mistake covered in this video was never believing Bitcoin might fall today. It's entirely possible it does. The mistake is treating an uncertain, unresolved macro event as a reason to make no decision at all, rather than as exactly the kind of moment a plan built in advance is supposed to handle, and then never tallying up what that quiet non-decision actually costs over enough uncertain afternoons to add up. That mechanism has a name, a measured coefficient, and a well-documented tendency to repeat around exactly this kind of event. It isn't unique to today, and it isn't unique to you. It can be planned around in advance the same way every holder who's made it through enough of these Fed afternoons eventually learns to, usually after paying for the lesson the hard way at least once. There's a version of today's story that repeats itself in some form roughly 8 times a year, every time the FOMC meets, and a version of it that repeats even more often once you count every CPI print, every jobs report, every geopolitical flare-up that puts a specific number on the calendar and a specific excuse in front of a holder's next decision. The mistake this video describes is not a once-a-cycle event. It's a standing invitation issued on a predictable schedule, and the only real question is whether the same response gets chosen every single time it shows up. Drop a comment below telling me honestly what your actual plan is for 2 o'clock today, hawkish, hold, or dovish, and whether you decided that before this video or are still figuring it out live. No judgment either way. If this changed how you're thinking about today's decision, send it to the one holder you know who's currently just waiting to see what happens, with no plan attached to that sentence at all. Every uncertain macro afternoon in Bitcoin's history has produced the same split. One group feels the same ambiguity everyone else feels, checks it against a plan built before the headline dropped and acts, or deliberately doesn't, on purpose. The other group feels the same ambiguity, has no plan waiting for it, and calls that freezing patience, usually without ever calculating what the patience actually cost. 2 o'clock is coming either way. The only open question is whether you're walking into it with a decision already made, or making one up in real time with the rest of the room. See you in the next one.